Welcome to this video on calendar time portfolios. My name is Alexander Hillert. I'm a professor of finance and data science at the Leibniz Institute for Financial Research SAFE and at Goethe University Frankfurt. In this video, I would like to explain the method of calendar time portfolios to you, which is one of the standard methods in empirical asset pricing. However, its use is not limited to empirical asset pricing because there are also applications in different fields, for example in corporate finance, where you would like to maybe measure whether a stock has outperformed or underperformed. For example, you could want to assess the long-term performance of initial public offerings, and one standard way to do this is to analyze it using calendar time portfolios. So if you have an empirical project that is somehow related to the performance of stocks, to trading strategies, then this video might be helpful for you. And the video is structured in just 3 parts. I would like to start with an introduction about calendar time portfolios, telling you the basics, telling you also the difference between calendar time and event time. Then we will jump into a bit of the technical details of calendar time portfolios, go through the different steps that you would have to program to analyze stocks performance using calendar time portfolios. And then at the end, we will conclude. This video does not contain an actual implementation of calendar time portfolios using real-world data in a statistics software. However, I have a separate video for you where we are going to replicate one of the prominent papers about the idiosyncratic volatility puzzle. And in this other video, I'm going to show you in detail data codes that you can use to implement calendar time portfolios. And we will replicate the Andrew Ng and co-authors IVOL paper. But here you just get the introduction, the basics about calendar time portfolios. So let's get started. What are calendar time portfolios? What is the main idea behind it? The main idea is that this is a method to analyze the performance of investment strategies. So let's assume you have a stock characteristic, a trading signal, and you would like to know, does this signal predict future returns? And the signal could be, for example, a stock had an initial public offering this month. Will the stock perform good or bad in the subsequent month? Characteristic could also be, you look at the past returns of a stock and whether a strategy that buys winner stocks outperforms a strategy that buys loser stocks, for example. And calendar time portfolios, or these investment strategies, they come with 2 time periods. You have the formation period in which you assign stocks to different portfolios based on your trading signal, based on your stock characteristic, and then the holding period in which you take the portfolios that you've constructed, track their performance, and see whether one of the portfolios outperforms or underperforms. More precisely, in the formation period, what you will do is at the end of the formation period, you will assign stocks based on the characteristic to different portfolios. Typically, these are 5 quintile portfolios or 10 decile portfolios. Then you buy the stocks in the long portfolio, that is the portfolio which you expect to perform well, and you sell short the stocks in the short portfolio, which you expect to perform poorly. That means you have a self-financing investment strategy, because by selling short stocks, you get proceeds that you can invest in the long portfolio. So for example, if you sell short stocks worth $1 million, you can take this $1 million in cash to invest it in the long portfolio and to buy the stocks that have favorable returns according to your trading signal. This holds in theory. In reality, it's a bit different because you might need to pose collateral when you lend shares to some shorts, there are transaction costs, so on and so forth. But theoretically, in a perfect finance world, the strategy is self-financing. Then when you formed your portfolios at the end of the formation period, you will keep the portfolios during the holding period. Depending on what these portfolios are, value weighted or equal weighted, you might need to do some rebalancing, but we will come to that later. Then at the end of the holding period, you will sell your stocks in the long portfolio, and then you will use the proceeds to buy back the shares of the short portfolio. And hopefully, if you have a successful trading strategy, you will be left with some money, with your profit. So in other words, the return difference between the long and the short portfolio is the profit of your trading strategy. So to summarize, at each point in time, you repeat this process of assigning stocks to a portfolio, initiating the positions, then holding the positions during the holding period, and closing the positions. So this is a step that you perform at each point in time, at each calendar time, and therefore it's called calendar time portfolio approach. For this approach to be implementable in the real world, it's important that when you do the assignment of stocks to the different portfolios, you are only using information that is available to investors at point in time T. Let's say T is the formation month, then at the end of that month, at the end of month T, all the information must be available. And the holding period, that is the time when you hold the stocks of the long and short portfolio, the holding period must not start before time T, it must start after time T, so that you have all the information you need for portfolio construction before the beginning of the holding period. To give you an example, at the end of month T, you could sort stocks based on their return from month T-12 to month T-1. This 12-month return is clearly known at the end of month T. And then you buy, let's say, past winner stocks, you sell short past loser stocks, and you do that at the end of month T, or equivalently at the beginning of month T+1. Keep these positions until the end of month T+1, and that would be implementable in real time. What would not work is if you, for example, would take the 12-month return from month T-10 to month T+1, and then at the same time assume that you know this return already in month T, even though this 12-month return includes month T+1. That would not be implementable in real time. To make the difference between calendar time and event time a bit more clear, I would like to contrast the two approaches here. Calendar time means you perform the procedure at each point in calendar time. So for example, we could have a trading strategy where we sort stocks during our entire sample period starting in January 2000 until December 2023. And then at the end of each month, January 2000, February 2000, December 2000, January 2001, December 2001, up to December 2023, you repeat the sorting exercise, forming portfolios, and taking positions. And that means for each time period, you will get a strategy return, and your overall average return of your strategy will be the equal weighted average of the individual monthly returns. That is, all time periods are weighted equally. So the average return here, to provide you with a formula, is 1 over capital T, where capital T is the total number of time periods. So in our example, it's 24 years. And then for each month during our sample period, we would get a return, and we sum up all the monthly returns and then divide it by the number of months in our sample period. And for the strategy, it's assumed that you invest the same amount of money at each point in time. This is because we weight time periods equally, so we assume that in each month we put the same investment capital in our strategy. In contrast, there is the event time approach. And here time is defined relative to the event analyzed. Let's say our event analyzed is an M&A announcement when a company announces to take over a different company. And in event time, we could have, for example, month T-1 could be the month before the M&A announcement. Month T could be the month of the M&A announcement. And month T+5 could be the month 5 months after the M&A announcement. And here we would decide, like, for each M&A announcement, what is the month before, what is 5 months after, what is the event month. And here our unit of observation is not like a calendar month, but here it's the event analyzed. That is, we weight all M&A announcements equally. So if we have 1,000 M&A announcements, we will determine the performance for each of the 1,000 announcements and then take the equal weighted average across all announcements. So here events are weighted equally, and the average return will then be 1 over n, where n is the number of events, and we would sum up the returns from the first event up to the last event in our sample period. The implication of weighting events equally means you invest the same amount of money in each event. That means if, for example, you have a calendar month in which there are like 100 M&A announcements, you invest 100 times more capital compared to a month where you just have a single M&A announcement. That means there will be some time periods in calendar time in which you put much more capital in your investment strategy, and there will be other periods where you only put little capital in your investment strategy. In contrast, this calendar time portfolio approach assumes that at each point in time you invest the same amount of capital. And if you think about like mutual funds, they have their set of capital that needs to always be invested. So for funds, it will be easier to follow a calendar time approach where they can invest each month the same amount of capital. With that, we have covered the basics about calendar time portfolios. And in the next step, I would like to dig deeper into the implementation of calendar time portfolios and show you the different steps involved in performing a calendar time portfolio analysis. Okay, let's start with the investment strategy setup. The first thing you need to think about is what should be the time frequency of your investment strategy. In empirical asset pricing research, a lot of studies are done on the monthly level, meaning that at the end of month T, you sort stocks according to a characteristic, and then you keep your portfolio in month T+1. At the end of T+1, you again sort stocks into new portfolios, keep these positions in T+2, and so on and so forth. However, you could also say, okay, let's do it on a daily level. Let's say each day we look at which stocks announced earnings today, and then we buy the stocks that had the biggest earnings surprise, meaning the firm that beat analyst and earnings forecasts, and we sell short stocks that failed to meet analyst earnings forecasts. That could be, for example, a strategy, and the earnings announcements are not only at the end of the month, but happen throughout the month. And then we could also have a daily strategy where we check for each day, like what are the new stocks that had great earnings versus what are the stocks that had poor earnings. When you have a higher frequency, so if you go to the weekly or even daily level, it means you have more trading and more transaction costs. This is like not really important if you perform standard academic analysis, where we typically do not take into account transaction costs, but if you want to get an idea of would the strategy be profitable in the real world, trading costs are maybe something to consider, and also maybe like what is your portfolio turnover at each point in time, what percentage of your portfolio, of your long and short portfolio, what percentage of stocks changes. Now, if you have come up with the frequency of your analysis, you need to select the characteristic you would like to use for your trading signal. And of course, these 2 points are a bit related, because like you have probably a characteristic already in mind when you decide, okay, do you need a daily strategy or is a monthly strategy fine? So maybe you should not think of them in like strict order, but more like a joint decision when it comes to characteristic and a suitable time frequency for your strategy. And then what you would do is, if you pick a characteristic, let's say we could pick the size of the firm measured by the firm's market capitalization, then at each point in time, meaning at the end of the formation period, we would sort stocks based on their market capitalization in, let's say, 5 quintile portfolios. Market cap is a characteristic that you measure at one point in time. So like on the last trading day of your formation month, what is the market cap of stocks? There could also be variables that you measure over longer periods going further into the past, so that you measure during the entire formation period. For example, you could construct a strategy where you look back over the previous 6-month return of a stock and then buy the stocks that had the highest returns, so buy past winners, and you sell stocks that had a poor return, meaning you short past losers. Then you will select your holding period. Often we just have a 1-month holding period. There are, however, also ways to incorporate longer holding periods. Let's say, for example, you have a 3-month holding period, but you still form your portfolios at the end of each month. So for example, in January 2024, you would form portfolios and you keep these portfolios then from the beginning of February until the end of April. At the end of February, you again update firm characteristics and construct a new set of portfolios that you keep from the beginning of March until the end of May. And then again 1 month later, at the end of March, you recompute your characteristics, take again positions, and keep these portfolios from the beginning of April until the end of June. And then it means that you will have 3 overlapping portfolios. One has been initiated just at the end of the previous month T. The second one has been initiated 2 months ago at the end of month T-1, and the other is from 3 months ago at the end of T-2. And then in my example here, in April, we would have 3 portfolios, one coming from the sorting at the end of January, the second one coming from the sorting at the end of February, and the third one coming from the sorting at the end of March. And then our strategy performance would be the average of the performance of these 3 portfolios. This setting here is called like overlapping calendar time portfolios, and this is a tool that has been shown in the empirical asset pricing research to produce a reasonable assessment of trading strategies, also produce solid test statistics when you want to check whether your strategy produces significant, in the sense of statistically significant, returns. So it's again a standard procedure. If you want to know more about overlapping calendar time portfolios, you can take a look at the Momentum paper by Jagadish and Titman, 1993. If you click on the link in the slides, it will take you directly to the Journal of Finance where you can download the article. But again, for many research papers and for many applications, you simply start with a 1 month holding period. And if your formation period is also 1 month, then it means that you have no overlapping portfolio. At the end of each month, you liquidate your existing portfolio and create a new one. When you've decided about the characteristics, the time frequency, and the holding period length, then you can take a closer look at the allocation of stocks to portfolios. In empirical asset pricing research, we typically form portfolios using percentiles to assure that each portfolio has the same number of stocks in it. And two popular approaches are quintile portfolios, meaning you have 5 portfolios and each contain 20% of the available stocks in the full cross-section. Or you could have decile portfolios, which means that each portfolio has 10% of the available stocks in it. How does this assignment using percentiles work? Well, in the beginning, we need to know what is the, in case of quintile portfolio, the 20th percentile, the 40th percentile, the 60th percentile, and the 80th percentile. Based on the characteristic we would like to sort stocks on. And then depending on what the characteristic of stock I is, compared to these percentiles, we will put it in one of the 5 portfolios. So let's say the characteristic of our stock I is just the median, so it's exactly in the middle of the characteristic distribution. Then it means it's larger than the 40th percentile, but smaller than the 60th percentile, meaning it would be put in the 3rd quintile portfolio. And this process of determining the breakpoints, the percentiles, and assigning stocks, this is repeated at the end of each formation period. Let me give you an example to maybe make that more clear. This example here is based on real-world data. So I used the stock file, the monthly stock file from the Center for Research in Security Prices, CRSP. That's the standard US stock market database. And then I kept all the observations from December 2023. And then I sorted stocks based on their market capitalization, measured as the number of shares outstanding times the closing price at the end of December. Sorted them in ascending order, determined the 20th, 40th, 60th, and 80th percentile. And that gave me the following breakpoints. So for the 20th size percentile, we have 0.053 billion, or equivalently 53 million US dollar. The 40th percentile would be 285 million. The 60th percentile is 1.245 billion, and then the 80th percentile is again larger, it's 5.3 billion. And based on these 4 percentiles, we would take a stock, let's say we have this Blue Star Foods Corp with a market cap of just 2 million, and this stock clearly belongs to our first quintile portfolio, so to the 20% of stocks with the lowest market capitalization. Then we could have another stock like Milestone Scientific Inc. Its market cap at the end of December 2023 was 52 million. That's just below the 53 billion threshold. So it still belongs to our portfolio 1. If we go a bit further up in our market cap distribution, we arrive at Fluent Inc. with a market cap of 54 million. This is above the 20th size percentile, meaning we put Fluent Inc. into our 2nd size quintile portfolio. And then you follow this logic here, and if you look at the larger portfolios, you might encounter some stocks that you are know or companies that you know. So for example, Harley Davidson has a market cap of 5.1 billion. That's still below the 80th percentile of 5.3 billion, but clearly above the 60th percentile. Therefore, Harley Davidson goes to the fourth quintile portfolio. And at the very top, we have companies like Macy's, just above the threshold. And then at the very, very top of the market cap distribution, we have Apple with a market cap of 2,994 billion US dollar. Okay, and of course, each quintile portfolio does not only contain 2 stocks. In reality, it would contain 20% of the full cross-section. At the end of December, we had a cross-section of about 4,000 stocks in the US stock market, meaning that each portfolio would contain 20% of 4,000 stocks, so roughly 800 stocks per portfolio. If we've done our portfolio assignment, we take the position in our long portfolio, take the position in our short portfolio, and keep the stocks during the holding period. Now, how would you assess the holding period of each portfolio? So what you need to do is for each calendar month, like February 2000, March 2000, April 2000 up to December 2023, you have to look at each portfolio separately and then compute the average holding period return of all stocks in that month in the portfolio. Now, why I'm starting with February 2000 and not January 2000. In the timeline that I had a few slides ago, we started in January. And here I picked February to just make the timing clear. Let's assume really that January 2000 is the first month in our sample period. That is, it will be the first month in which we can sort stocks based on their firm size and assign them to portfolios. So at the end of January 2000, we form our portfolio, meaning that February 2000 will be the first month of our holding period in which we can measure the stock's return. And that's why my timeline here starts in February and not already in January, to make clear that the holding period always follows 1 month after the formation period. Or it could also be further in the future, of course, but for this strategy, we simply assume in month T we form our portfolios and in month T+1 we hold our positions. Now, how would that go? So we take those stocks in quintile 1 here in February 2000, and we have a bunch of stocks here. A Inc., it earned 3% return in February 2000. B Inc. lost 9% in February. E Inc. gained 5%, up to, let's say, X Inc. would be the last stock, did very well, earned 17%. Then we would take the average of the performance of all stocks in this portfolio, and in my example, that would be 4%. Then we do the same in March. Remember, the portfolios that we have in March have been formed at the end of February, and there could be changes from January to February. But stocks can also remain. So if the market cap does not change a lot and if breakpoints do not change, then companies will still be in the same portfolio. Like in my example, A Inc. here was part of the portfolio in January and is also part of the portfolio in February, or in terms of holding periods, like was part of the holding period in February and is also part of the holding period in March. B Inc. however dropped out, while C Inc. joined the portfolio, and also E Inc. is replaced by F Inc. Again, we take the average of the individual stock returns of all stocks in quintile 1 in March 2000, and we get a return of minus 5.5%. Then we do the same for all months up to December 2023, where we have now a complete different set of stocks in our portfolio. and again a slightly negative return with -1%. We do this procedure not only for quintile 1, but also for quintile 2, 3, 4, and 5. With that, we get a time series for each portfolio. So we are like now no longer on the individual stock level like here, but are just on the portfolio level, meaning that we have 5 portfolios, for each portfolio 1 time series of returns. So in total we have 5 return time series. Before I continue with that, I would like to talk a bit more about what does it mean to take the average of the return in the portfolio. In my simple example here, what I did is I computed an equal weighted average, so just the mean of the performance of these stocks. However, that's not the only options that we have. We could also value weight the stocks in a portfolio. What is the difference here? When we take an equal weighted average, we assume that we have the same amount of money invested in all stocks in the portfolio. So we have basically an 1/n investment strategy. If there are like n stocks in our portfolio, let's say 800 stocks, we invest 1/800 of our capital in each of the stocks. If we hold portfolios for longer, let's say we hold them for 2 months, then what we need to do at the beginning of the second month is we need to rebalance the weights of our portfolios. Why is that? So let's assume, very simple case, we just have 2 stocks in our portfolio. We have stock 1 and stock 2. Stock 1 performed very well, increased by 50%, while stock 2 lost 50%. In the beginning, we invested like 100 in both, meaning that we now have an exposure of 150 to stock 1 and only of $50 to stock 2, meaning that stock 1 has a 3 times higher weight than stock 2. And then in this case, the return in our second month of our holding period will no longer be an equal weighted average, but we would give 3 times more weight to our stock 1 relative to our stock 2. Therefore, what we need to do at the end of our first month, rebalance to equal weights, meaning we would need to sell $50 of stock 1 and buy an additional $50 of stock 2 to get back to an equal exposure, $100 in stock 1, $100 in stock 2, to get again an equal weighted return in the second month of our holding period. You already see that this involves a lot of trading, so in reality it would not be a clever implementation because we would accumulate a lot of transaction costs. And strictly speaking, this weighting would not be needed on the monthly level, but it would, strictly speaking, be needed on a daily level. Now, what is the alternative? The alternative would be a value-weighted portfolio. Here the idea is that we get a larger weight, we put more money into larger stocks. So if we have Apple and this Fluent ink that you saw on one of the previous slides in our portfolio, we would put much more capital in Apple shares than in Fluent ink shares. This is much easier to implement in the real world, not only because large shares tend to be more easily traded with smaller bid-ask spreads than small shares, but also we need less rebalancing. So coming back to my example with stock 1 and stock 2, where stock 1 gained in value while stock 2 lost in value, at the same time, if the stock gained value in our portfolio, the overall market cap of the stocks will also change. And if a stock goes up by 50%, of course the weight in our portfolio goes up, but at the same time also the market cap goes up and the increase is like 1 by 1, so we don't have to do any rebalancing trades. And this is also why these value weighted indices are so popular. and why you see that many market indices like the S&P 500 or the DAX 40 are all value-weighted indices and not equal-weighted indices. Okay, then I have one more piece of information for you about value-weighted portfolios. When I say, okay, we need to weight them by the market capitalization, I'm like not 100% precise at what time we need to measure market capitalization and what should become the weight. Is it the market capitalization at the end of the formation period, at the end of month T, or is it the market cap at the end of the holding period, month T plus 1? So let's look at an example and figure it out. What would we do in reality? We would buy our positions at the end of month T or the very first trading day of month T plus 1. And let's say the market cap is 100 for stock A, 50 for stock B, and 10 for stock C at the end of the formation period. That means we would also give, in total that's like 160, then we would give 100 over 160 exposure to stock A, 50 over 160 exposures to stock B, and 10 over 160 exposure to stock C. And that would be the weights, and we would earn the return based on these weights. For simplicity, let's assume also our capital to invest is exactly 160, then we could invest like 100 into our stock A. We earn a 20% return, meaning we have a profit of 20 here. We invest 50 into our stock B, earn a 10% return, meaning we have a profit of 5. And for stock C, we invest 10. Stock C does not yield any return, meaning we have a profit of 0. Then we have 25 in the numerator divided by our overall investment. We invested in total 160. So 25 over 160 would be a return of 15.63%. And this would be perfectly implementable because at the end of month T, when we form our portfolios, we know the market cap, so we could perform the strategy in reality without any look-ahead bias. Now an alternative would be, okay, we take the returns of month T plus 1, then it seems like logical to take also the market cap of month T plus 1 because like it looks consistent. So let's do like a little exercise. So let's assume we had 120 invested in stock A, and at the end of month T plus 1 we have the 120 in stock A. So 120 times the 20% plus the 50 times the 10% plus 10 times 0% divided by like what is the market cap at the end of our period. It will be 185. And if you look at the return here, we get 15.95%. Okay, so we get a different number. Now, which of the two solutions is correct? Well, only the first one is correct because when we make our investment at the end of month T, we don't know which of the three stocks will perform well and which of the three stocks will perform poorly. So the third column here, the last column where you see the market cap at the end of month T is unknown to us at the time when we form our portfolios. So first of all, this is not possible to implement in real time. Also, this strategy would basically imply that you know ex ante which stocks are winners, stock A and B, and you put more money, relatively more money, into these stocks already ex ante. And this is why when you do this computation incorrectly, if you take the end of the holding period market cap instead of the beginning of the holding period market cap, you will always get a portfolio return that is biased upward. Because like you avoided losers, and you overweighted winners, even though you did not know yet which stock will become winners and which stock will become losers. So it's important that if you compute value-weighted portfolios, take always the market cap, not in the holding period, but at the end of the formation period. Okay, with that, we can go back here. Now you need to know everything about how to compute this cross-sectional average. Like I said before, we now have only 5 portfolios, each with 1 monthly time series. And now we would like to know what is the average return of your strategy. So how do the 5 portfolios perform typically? So what we do, you see here is a table where we have our 5 size quintile portfolios, again starting in February 2000, the first holding period month in our sample, and ending in December 2023. And then we have the monthly returns. Just for consistency, we can go back here. We had 4%, minus 5.5%, minus 1%, and you see the same numbers shown here in the table. And now we take a time series average to see how good or how bad did these 5 portfolios perform during our sample period. And in my example, the size quintile portfolio 1 earned 0.5% per month. So 0.01 would be exactly 1%, and here we have 0.005, meaning 0.5 percentage point or equivalently 50 basis points. We take also the time series average for portfolio 2, that would amount to 75 basis points, and then we have our high portfolio here, where we have 150 basis points. Now, we already see here, okay, it looks like that our portfolio 5 has a higher return than our portfolio 1. And more precisely, we have a higher return of 1% per month. 50 basis points versus 150 basis points, meaning that an investment strategy that buys the high portfolio, quintile portfolio 5, and sells the low portfolio, quintile portfolio 1, earns in the typical month, in the average month, a return of 1%. And then we would perform a statistical test to see whether this return of 1% per month is significantly different from 0. And it could be, for example, that you get a t-statistics of 2.47, meaning that we can reject the null hypothesis that this return is equal to 0 at the 5% significance level. 5% significance level requires that the t-stat must be larger than 1.96. However, it's not significant at the 1% level, which would require a t-statistic of 2.58. So here we would conclude, indeed, it looks like that we have a trading strategy that delivers positive returns. Now we found this difference in raw returns. Raw returns means we did not account for the riskiness of the portfolio. However, it could be that for some reason the stocks in portfolio 1, they have little systematic risk, so they have a low beta, and in this case the capital asset pricing model tells us they are less risky, carry only little systematic risk, and therefore their expected return is relatively low. And it could be that our stocks in our quintile portfolio 5, they are quite risky. They have a high beta, and therefore the capital asset pricing model tells us they should earn the high beta times the market risk premium, which translates to a high expected return. So it could be that this return difference here is not really a lucrative trading opportunity, but it's just a compensation for the stocks in portfolio 5 having more systematic risks than the stocks in portfolio 1. To test that, what we need to do is we need to look at risk-adjusted returns, where we control basically for the amount of systematic risk that we have in the portfolios. How would we do that? Well, we would take the return of our portfolio, subtract the risk-free rate. That would be an excess return in excess of the risk-free rate. And then we would regress that on the market factor, more precisely the market excess return. And then we get an alpha and a beta. And the alpha here is the risk-adjusted return. So this example here that works for computing the alpha for an individual portfolio, you can also directly compute the alpha for the high minus low portfolio. In this case, you would have the return of portfolio 5 minus the risk-free rate minus opening bracket the return of portfolio 1 minus the risk-free rate closing bracket. Now this return that we have in brackets minus in front of the brackets times minus risk-free rate in the brackets gives us a plus risk-free rate, and then this minus risk-free rate before the brackets plus the risk-free rate cancels out. So we could also have directly the return of portfolio 5 minus the return of portfolio 1 equals alpha plus beta times the market excess return. And then we could run this regression and see whether we get a significant alpha. And it could be that we get an alpha of 1% per month, which is statistically significant. That would mean that the beta, the systematic risk of the stocks in portfolio 1 and 5 is about the same. Therefore, this return difference is not explained by differences in systematic risk. Or it could be that we get, let's say, an alpha that is much smaller and maybe not statistically significant. Then that would indicate that indeed the stocks in portfolio 5 have more systematic risk, and therefore the higher returns are just a compensation for more systematic risk and are not an abnormal return. With that, I'm done with explaining you how calendar time portfolios work. Let me briefly summarize the most important points that we talked about. Calendar time portfolios are one of the standard methods in empirical asset pricing. The other method is Farmer-Macbeth regressions. The calendar time portfolios come with two time periods. We have the formation period, at the end of which we assign stocks based on a trading signal, stock characteristics, to portfolios. And then we hold these portfolios during the holding period, meaning we buy the stocks in our long portfolio and sell short the stocks in our short portfolio. We perform this procedure at each point in time. That's why we have the name calendar time portfolio approach. Then we can decide how we would like to compute the average cross-sectional return. Would we like to have at each point in time and for each portfolio a value-weighted return or an equal-weighted return? However, what they have in common is that within each portfolio and within each point in time, I take the cross-sectional average across the returns of all stocks in the portfolio. And then when we've done that, we have a pure time series for each portfolio, and then we take the time series average of portfolio returns. That is, we take the time series average of the cross-sectional return averages. And then we can finally also adjust this time series of portfolio returns using your preferred asset pricing model. Could be the capital asset pricing model, but could also be the Farmer-French 1993 3-factor model, or the Carhart 97 4-factor model, or any other asset pricing model you have in mind. And then you would basically test, do you still find a significant alpha after adjusting for systematic risk? If that's the case, you have a profitable trading strategy. If not, you don't. In terms of references, I just have one reference for you. It's the Jagadish-Titman momentum paper, which is helpful when you want to learn more about overlapping holding period returns. So what do you do if you have multiple portfolios during your holding period? How do you arrive at the average return of your strategy? With that, I hope you enjoyed this video and I thank you very much for watching. I hope you find it helpful and have now an idea of what you need to do when you would like to implement calendar time portfolios. We are very happy to receive any feedback, or also feel free to contact us if you have questions. You can reach us at datacenter@safe-frankfurt.de. That's it for today. I look forward to seeing you in the next video, in which we were going to talk about how can we actually replicate a study using calendar time portfolios, and we will do that in form of a case study of the Andrew Ng and co-authors idiosyncratic volatility paper. Thanks again and keep exploring.